Welcome back. We're looking at an analysis of Bitfarms today.
A really deep dive.
It explores their huge 156% revenue growth in Q3 2025 and, more importantly, their big pivot into AI infrastructure.
So let's get straight into it. The core thesis is powerful, but to really make it land, the argument needs to be tightened up.
Okay, so where do we start?
I think with the structure. The report needs a much more explicit connection between the past, the Q3 earnings miss, and the future, which is all about these AI growth catalysts.
Right. As it is now, it feels a little sequential.
Exactly. It lays out the impressive stuff first, 156% growth, that's $69 million in revenue.
Which is a huge number.
A huge number. But then it follows with the reality check. They actually missed analyst estimates. The street was looking for something closer to what, $88 million?
And then it presents the AI pivot, the Washington conversion, and the new Pennsylvania hub as the big solution.
The weakness there is that these feel like three separate facts.
Instead of one single story.
Precisely. The most important insight, that the stock got punished not for failing, but for failing to grow even faster, is buried in a key takeaway.
So it's not the central organizing principle, which it should be.
It has to be. If you don't establish that market inefficiency right away, then these huge AI projects, they just look like an optional diversification plan.
Not an urgent strategic necessity.
Right. They don't look like an escape route.
Let me push back on that for a second, though. The report starts strong with that 156% growth. It's a powerful hook. If we start with the miss, aren't we risking a more defensive tone from the get-go?
That's a fair point, but I think real explosive stories need that tension. The idea isn't to dwell on the negative. It's to frame that $69 million as the absolute peak of their old model.
Okay.
The Q3 miss then becomes the moment the market said, this is it. The Bitcoin mining only multiple is capped. We need more.
So the miss is actually the catalyst. It's the reason for the whole re-rating argument.
Exactly. So the suggestion is to reframe the entire structure. Immediately establish the price inefficiency created by that earnings miss. Then the AI pivot becomes the clear, obvious solution to that growth gap.
So it's not just about adding revenue. It's about escaping the very thing that caused the miss.
That's the story. It gives the whole analysis purpose.
Okay, so how do we do that? Concretely?
Well, for example, instead of starting section 1 with the headline number, the $69 million, you could start with the disconnect.
Frame the Q3 miss as the opportunity.
Yes, as the buy the dip moment for investors who can see what's coming next. You could even title that section something like The Cap. Why 156% growth wasn't enough.
That's strong. I like that. It immediately poses the problem.
Then you position the AI pivot, the NVIDIA GB300 GPUs in Washington, the massive scale of the Panther Creek data center, as the definitive answer to that problem.
So the AI section is no longer just some other project. It's the core of the thesis.
It becomes the mandatory strategic move. It basically says this explosion is only possible because they learned their lesson in Q3.
I see. That framing really changes things. It's not just, here's what happened. It's, here's the problem and here's the elegant solution.
A perfect narrative bridge. Which, of course, brings us to the next point. If the AI pivot is the solution, we have to quantify what that solution is actually worth.
Right. So let's move on to that. The bull case is ambitious, $7 a share. That's, more than 125% upside from here?
A big target. And to support it, the analysis needs a much stronger quantitative bridge between their current valuation and the future value they'll get from this AI pivot.
The report does a good job of setting the stage. It points out that BITF trades at a lower multiple, enterprise value to hash rate, than peers like Marathon or CleanSpark.
It does. That part is clear. But here's the weakness. It sees that valuation gap, it points to the $7 target, but it never really quantifies how much of that target comes directly from the AI business.
You mean how much is from the higher margins you'd expect from AI and HPC post-2026 versus just them getting better at mining Bitcoin?
Exactly. Without that separation, it's more of a philosophical argument than a financial one. The market isn't just going to re-rate the stock on a promise. It needs to see a new, high-margin revenue stream and apply a new multiple to it. If mining gets you to $3.50, you have to show the math for how AI gets you the rest of the way to $7.
So is the argument that the entire company gets an AI multiple, or that we should value the AI part separately?
I think the analysis needs to be clear on that. The best way is to use the precedent of competitors. Look at IREN or CLSK. They saw massive re-ratings once they moved into this space. We can use them to build a model.
Okay, so we're not just inventing a multiple out of thin air. We're applying one that the industry has already shown it's willing to pay.
We're applying an observable precedent. Those companies basically swapped a logistics multiple for a tech multiple once they landed those big compute contracts.
That makes sense.
So if Iron's HPC revenue is getting, say, 8-10 times EV to revenue multiple, while mining is at 2 times, the reader needs to see that math applied to BITF's projected AI revenue.
From the Washington facility or Panther Creek?
Yes, you have to show the calculation.
So give me a concrete example. How could the report really enhance this section?
Okay, so one way is to provide a directional estimate that anchors that $7 figure. For instance, calculate what percentage of the $7 bull case is attributable only to the Pennsylvania hub.
Just that one project.
Just that one. Estimate the potential annual revenue from that data center's capacity and apply a reasonable multiple to it. If that alone justifies, say, $3 of per share value, suddenly the whole case feels much more rigorous.
I like that. Isolating the variable. It shows you exactly where the upside is coming from.
Or you could do it another way. State explicitly that the $7 target depends on the market giving them a 50% higher EV to revenue multiple than their mining peers, but only once the Washington conversion is done and they've signed their first contracts.
That's also very clear. It turns it from a simple comparison into a projection with specific milestones.
It changes the conversation from they're cheap to here is the quantifiable path to them being worth more.
Which is vital. But of course, that path costs a lot of money. Which brings us to the risks.
Absolutely. And success here has a huge price tag. We have to address how they're going to pay for this.
Yeah, the report has a risk section, but for a piece that's recommending a long-term hold for a $7 target, the risks feel a bit disconnected from that specific price.
I agree. The analysis is right to be cautious, but it needs to be more specific about how potential equity dilution, which is almost certainly necessary to fund these $300 million plus projects, directly impacts that upside for shareholders.
Right now, the weakness is that it's too general. It just says dilution is a risk. Well, of course it is. They need over $300 million for Panther Creek alone. But for an investor who's willing to hold on through the volatility for that $7 payoff,
they need to know how much dilution that target can actually handle before it breaks.
Exactly. If the company gets the AI contracts but they have to double the share count to do it, the win per share is a lot smaller.
The reader has to understand the mathematical ceiling.
And does the report really connect the dots between that $300 million financing facility and the inevitable dilution?
It needs to be strengthened. The suggestion here is to provide a sensitivity analysis.
Okay.
Focus on how potential increases in the share count mathematically affect those price targets. This takes it from a vague warning about dilution to defining the actual structural risk.
That's constructive. You have to define the cost of the explosion.
You do. If you're telling investors to believe in a $7 future, you owe it to them to show the maximum price of admission.
So, what would be the most actionable way to implement that? What are some concrete examples?
You need to model a couple of realistic scenarios. Let's say for that $300 million needed for Panther Creek. First, calculate what the realistic per-share price target becomes if the share count goes up by 25%.
Okay.
Then run a more conservative case. What if it's a 35% increase?
That makes the risk section incredibly useful. It tells the investor, look, if they fund this with equity and the share count goes up by X, the new realistic ceiling is Y, even if the AI part is a home run.
Precisely. And if the analysis shows that even with 30% dilution, the AI segment still justifies a share price of, say, $5.50 or $6, that's still an incredibly strong case for holding through the volatility.
Right. It turns the risk from a generic threat into a number that an investor can actually track.
And it gives them a clear metric. If Bitfarms funds the project with debt, the investor knows the $7 target is still in play. If they announce a big equity offering, the investor knows exactly what that does to the theoretical ceiling.
That level of detail, connecting the execution risk directly to the per-share value, that really elevates the entire analysis.
No question. It makes the recommendation transparent and highly defensible.
This has been incredibly useful. I mean, the report has great bones. That 156% growth, the AI strategy, those are powerful catalysts. But these adjustments will make the logic totally unassailable.
The material absolutely identified the potential. Our focus was just on making sure the framework supporting it is engineered to handle the complexity of such a fast transition.
So, to summarize the big actionable suggestions. 1. Realign the structure so the AI pivot is the direct solution to the Q3 earnings miss.
Make that the core tension.
2. Quantify the AI re-rating. Build that clear mathematical bridge from today's multiple to the projected $7 target.
Show the math.
And 3, get specific on the dilution risk. Detail exactly how financing impacts that $7 goal using a sensitivity analysis.